All right, so we're going to take a run through the trades of the 19th of December, 2024. Okay, so we're going to start off with how we found the shorts yesterday. All right, so here's how we looked at it. Starting off with the day break, right? This is the beginning of a new day. This vertical dotted line. All right, so the market comes into play basically, let's just say from midnight all the way till 8 a.m. this range. I think 8 a.m. should be roughly around there. Let me just check this here. All right, so okay, that's 8:30. Okay, just a little bit back, 8 o'clock. Okay, so this would generally be our Asian range. Now, we know based on the rules that the Asian range is responsible for setting the high and the low of the day. So this was the highest point for the Asian range. And obviously, this is the lowest point. Okay, so the Asian range runs for about 6 to 8 hours. And we start off here midnight, South African time, all the way to 8 a.m. So anything in this blue box is considered to be part of the Asian range. Now, based on how we look at things, we saw this rally up and then the market went into consolidation. Now, is the moment we see consolidation, that tells us that there is some type of accumulation happening in the market. By accumulation, we mean that the market makers or the big players or the powers that be have held this market in a range to accumulate orders. Now, we know that there was a big push to the downside the previous day, and then we see in the early hours of the morning, 19th of December, we see this small rally and then it goes into consolidation. Now, what people would normally think is that this is basically them consolidating, or this was probably a retracement, then they consolidated, and then they're going to probably push further down. Now, with this notion, the market makers like to manipulate people into taking trades or into being taken out of their trades, right? So we see this rally, then consolidation. Now, what the market did in the Asian session is set a high, right? So we're going to mark it off with this line over here. So the market set a high, right? And then what we see is after consolidation, right after the Asian session, going into London session, that high was broken. So a new high was set right over here. Now, once the new high was set, we are at a point where we're thinking we're looking for shorts because we know we always short at the high and we take longs at the low. So what we have here is a new high that was set right over here. Now you see that the market came to this high, they hit the high, they pulled back, then they came and hit the high again, but didn't really break it with this candle here. Now we see that we've got equal highs. So first of all, we had a high. Now that high got rated, right? We call it a raid. So that high got rated, right? And after that high got rated, we set a new high, which is this one. Then that new high was hit again, but not broken. So that created what we call equal highs. So we just say EQH for equal highs. Now, what is the rule with equal highs? We know that when we have equal highs, the chances of that high being hit are very high because of what we call liquidity. So even at the initial high that was set, we know that there was liquidity above that high that needed to be taken out, and we see it being taken out by this candle here. But the market will go for this high, which is more liquidity at this high. And then we see that another high was made here, but even though they're the same highs, equal highs, there's more liquidity. So in order for us to take a short, we need to see these highs taken out. We need to see the liquidity grab at this high. And when does that happen? When this candle forms. This candle came in, hit the high, hit a level of interest, which is 26.25, which is a quarter point on gold. This is gold, by the way. A quarter point on gold, hit the 26.25 area, taking out liquidity, and then we see a nice bearish M5, M15 candle. So we entered our shorts from there at the close of this candle with our stop loss right above the high. Even though this was a large stop loss, right? What we normally do is we try and get in at the best price possible. So the correct entry would be at the close of this candle, but we normally wait for retracement and we look for reasons to take the trade on a lower time frame. So we kind of did take the trade somewhere at the high of that candle, the next candle, and we had a stop loss at about 30 pips. So 30 pips was around about there, right? And our initial target was the whole number, which is 2600, and that gave us a cool 300 pips from the initial move, right? Our second target was way down here at the fair value gap. Now, this is where it gets interesting, right? So we have our initial trade. That was one, right? So just here, right? That initial trade was one. We close our positions, and then now we look for reasons to buy. Now, first things first, we have in this area here, we have what we call a fair value gap, right? Let's just move this to the side. Okay, so in this area, we have a fair value gap. Now, fair value gap, I'll explain how we see fair value gaps, but first we'll start by drawing it out. Okay, so we have the fair value gap over here. And below the fair value gap, we have what we call an order block. So this is something that I've seen time and time again, which is quite interesting in the market, right? So I'm just going to draw this right till here and let's make it white. Okay, so our target was the fair value gap. We hit the fair value gap nicely, and then we were looking for reasons to buy. Now, we normally would take our buy in our fair value gap. Now, let me show you how the fair value gap is created. So we have a push to the downside. So we have a swing low right here, and then we see the market raiding that swing low. Basically, the same thing that happened with it raided the swing low. So we've got that raid, the liquidity is taken out. And then we see a push to the upside, and they create a swing higher here, and then they consolidate, they retrace back down, and then they push up, breaking this high right here. Now, this is what we like to see in terms of fair value gap. When the market raids a high, a swing high, or a swing low if it's going to the downside. I'll show you that too. So we see the swing high broken by this candle, and this basically leaves a gap, which is the fair value gap, right? Now, below the fair value gap, we have what we call an order block, the last down candle in a downtrend before the massive up move. So we also mark that off. Now, the market came into the fair value gap, but didn't respect it and broke down into the order block, right? So it came into this order block right here, and that's when things got interesting, and that's when I decided to look for entries on a lower time frame. So first of all, on the 5-minute time frame, when I first came to the market here, I checked the 5-minute time frame. In fact, when we got to the fair value gap, watching this doji right here, I thought the market was going to go up. And then looking at the follow through of the next candle, I actually didn't take this trade because I didn't see it happening. I came slightly late, so which was good for me because I probably would have taken the trade and taken a nice little L over here. But lucky enough, I wasn't on the market at that time, even though I had alerts, but I didn't get to see it in time. And then the market went into the order block, right? So at the order block, this is where it really gets interesting, right? So we have the order block, the market taps into the order block and then starts to show signs of wanting to go up. But on the 5-minute time frame, I didn't have reasons to take the trade. So let's take out this fair value gap since it wasn't respected. Now we're left with the order block. So on the 5-minute, I didn't see a reason to take the trade based on what I normally look for. So I decided to go to the 1-minute time frame and have a look at what was possibly shown. Okay, so let's just go a little bit back, a little more back, a little more back till we get to that zone. All right, so here we are, 1-minute time frame inside our order block, right? Okay, so we see the market is making a series of lows, right? Making a series of lows, keeps on taking out the liquidity on the lows, on the swing lows. And then here we have the market making a low, then making a swing high, and then making another swing low, a small swing high, and then breaking this low, this inner low, but not breaking the main low, the main swing low. And then we see the market rallying up, breaking this small swing high, just like how I showed you the fair value gap before. We see the market breaking this intermediate high, right? And then creating a fair value gap. So we see these 3 consecutive candles, 1, 2, 3, the break of this high. So we mark off this candle and the bottom, the top of that candle and the bottom of this candle, and there's our fair value gap. Now, we see the market coming back into the fair value gap, tapping into it, and then giving us a bullish candle. And this is where we took our initial trade, right in here. And our stop loss just goes right below these candles that created the fair value gap. That was a 20 pip stop loss. Our first target, now this is how we draw our targets. We aim for liquidity sweeps, right? So here's our first one, right over there. And this another swing high as a potential take profit zone. And we keep on marking most of the swing highs so that we can continue to take liquidity at those highs. We're going to mark off some more liquidity. I'm going to show you how we managed to take almost all that liquidity, right? So there's just a lot to draw, but I can assure you only this morning as the trade continues, we've taken more liquidity. But last night, where I stopped trading, basically it was at this level 2600, which gave us a lovely 110 pips or so, right? So I'm just going to extend this here, and you can see that's where we hit our take profit. But our complete target is 2610. That's where the overall target is, and I'll show you why. Okay, so we go back into this here. Let's just go to the current chart. Right, here we go. Now, why 2610 being the target? We are looking at this swing low here, and we're looking at how it got rated by these candles on a higher time frame. You'd probably be able to see that we have what we call another fair value gap. 1, 2, 3 candles, and then we're going to mark out the fair value gap right here. Right, let's just start all the way here, right till there, and we're going to look at 50% of that zone. Let's use the fib tool here. Okay, and 50% of that zone just comes here. So it's actually 2612, not 2610. So around about 2612, but just to be safe, we always leave a couple of pips room for it to actually hit our take profit. So that's why we set it at 2610. So the initial, the correct zone will be around about 2612, but we left it at 2610. And we're fairly close to that target. And that would give us from that entry at least just a little further, 2610. That would give us at least 210 pips, but we're aiming for 200 pips. So you can see that we have a 1 to 10 RR, a 1 to 10 risk to reward ratio with a 20 pip stop loss, a very small stop loss with a huge movement to the upside. And that's how we went about our trading day yesterday, from the shorts all the way down to the long. So it is possible to take both sells and buys all in the same day, as long as your confirmations line up and your trade is set in the way that you normally take your trade. So always follow your rules, always have proper risk management, and you should have a profitable day. Okay, so that's that. Thanks for watching. See you again soon.